Welcome to the seventh in a series of videos that explains how to complete the financial statement and analysis system spreadsheet. This spreadsheet is part of the University of Wisconsin Division of Extension's Farm Management Pulse program. The full curriculum and spreadsheet itself can be found at the website addresses that are shown on the visual. My name is Kevin Bernhardt, and I'm both a farm management specialist for the Wisconsin Division of Extension, as well as a professor in the School of Agriculture at UW-Platteville. This video introduces and explains how to complete the balance sheet Schedule K, which is all about valuing leased assets. So let's get started. Leasing assets is common in farm business. There are two major kinds of leases, and they are treated differently in financial statements. We have operating leases, which are common for renting land, buildings, and even machinery for up to just 1 year for a short term. There's no expectation of ownership at the end of that 1 year when the lease is done, and operating leases are not recorded or part of the balance sheet. There'll be an expense on the income statement, but not a part of the balance sheet. So with respect to any further discussion on operating leases, we don't have to do that with respect to the balance sheet. The second type of lease, however, is called a capital lease, or sometimes referred to as a financial lease or a finance lease. Capital leases are longer term. They typically are for multiple years, and at the end of the lease, there is usually an option for purchase of the capital asset. That transfers a lot of the risk and ownership to the leasee or the farmer, and therefore it looks a lot like ownership, although technically it is not. Because of this closeness to ownership, the Farm Financial Standards Council recommends that a capital lease is part of the balance sheet and should be treated similar to a purchased capital asset. So let's go to the balance sheet itself, the schedules. So let's first of all just take a minute to fill this out. So here's Schedule K for leased assets. We're going to lease a tractor, and we're going to lease it for multiple years, so it's considered a capital lease. The intermediate asset value of this capital lease is $42,501, and I'll explain these numbers after we get them all in. The current liability is going to be lease payment, if you will, is going to be $8,190. The accrued interest is $2,851. The intermediate liability, or in other words, the amount of lease payments that we have to pay after this year, accumulate up to $29,820. And depreciation on this capital lease, if we consider to be ownership, and we looked at depreciation, it would be $7,500. Now, note these same entries will be used, some of these entries will be used on the income statement as well. So we're also sort of completing something that we'll use later on. The bigger question you may now be asking is, where do these numbers come from? Because of the complicated way of valuing assets, we actually have a separate tab on the spreadsheet just for the purpose of finding these numbers. So let's turn our attention to that now. So I'll come back to this later on, but right now at the bottom of the page, at the bottom of the screen, you'll see the various tabs there. And we're going to scroll over until we get to the Capital Lease Schedule tab. And I'm going to click on that. And the Capital Lease Schedule tab has two different tables on it. Table 1 at the top, which runs from rows 1 through 13 or so. And then below that is Table 2. Now, both of them give you the same information, but in different ways. So Table 1 is a place for you to record all the items that you have a capital lease for: a tractor, a combine, whatever else you might have, all the things you have a lease on. Where Table 2 allows you to record information for just one item, but you can see a lot more information for that one item. Primarily, Table 1 is the one that's going to be the one that you're going to want to use most often. So it's a place to record all leased assets, where each row is for a separate leased asset. So let's look at the tractor that we have for Wisnet Farms. So in row 4 here, you see the tractor has already been listed. The year that the lease was started, we're going to assume is 2015. And we're going to assume that that lease was started in April. April is the 4th month of the year. So we're going to put a 4 there, which represents April. The length of the lease, we're going to have this lease for 5 years. That's what we signed the contract for. The interest rate is going to be 10%. And we have an initial payment at the time we sign the contract right away. We're going to make an initial payment up front. And that initial payment is $11,991. And then we're going to make annual lease payments after that until this lease is over with. And those annual lease payments are also going to be $11,991. Now, they wouldn't have to be the same values. In this particular case, they are. The last entry we need to do is to tell the spreadsheet which year we are analyzing, because we might have several different items listed here, all of them which started in a different year. We might have one from 2015, one from 2014, one from 2016, one from 2018, et cetera, et cetera. And so they all might be a different year. And based on what year it is, the numbers are going to be different for each individual item. So the way to tell the spreadsheet which year we're analyzing, and in our case, we're analyzing 2015, we're assuming, is up here in this yellow cell that's D2, cell D2, where it says year being analyzed. I'm going to put 2015. And that tells the spreadsheet that we are analyzing year 2015. Now, we have all the information in there, and the way that the Farm Financial Standards Council suggests that you value leased assets is by using the present value of all future payments. Now, that's a lot of financial jargon, but the spreadsheet has all that math in the background that allows that to be calculated. So if we go over here and look, we look to the side, I'm going to scroll over. We see current liability for the year 2015, non-current liability, total liability, asset value, the accrued interest, and the depreciation expense. All that is calculated for 2015. Now, if I were to change it to something, a year analyzed being 2016, some of these numbers are going to change. So that's why we have to put that there. But those are the numbers that we need. They follow the Farm Financial Standards Council recommendations for how to value a lease using the present value of all future payments. They calculate accrued interest based on the date of the balance sheet and so forth. And they also include depreciation, because you're pretending like you own this particular asset and it does fall in value over time. So all that will be there as well. Now, one thing to note is that these values do not automatically transfer over to the balance sheet schedules. So this is a separate standalone schedule. Once you have the numbers, you'll have to take those numbers and automatically bring them over. So for example, where it says we have a current liability of $8,190 and we have accrued interest of $2,851, I would have to take those numbers, go back to the balance sheet schedule, balance sheet schedules K, and under current liability lease payment, there's my $8,190, but I'd have to manually put that in, and my accrued interest of $2,851, my depreciation, and etc. So that's how we find those values of those leased assets. Table 2, by the way, on that tab was a way of diving deep into just one asset and looking at what it would be over time, one leased asset over time. So it gives you the same information, but only for one piece at a time. So leasing capital assets is a great tool to have. It's a great way to get control of assets for the farm. And we just have to make sure to appropriately value them on the financial statements. There's a final schedule here that is called Schedule L, investment in cooperatives and other non-current investment in assets, both intermediate and fixed. I won't spend much time on this schedule. It's sort of a catch-all. It's an other or a miscellaneous, if you will. If we haven't captured all the assets somewhere in the schedules above this, this last Schedule L is a place to get the final ones. Now, that completes all of the discussion and videos for how to do the asset side of the balance sheet. What's next is the liability schedules. And the good news is that that is much, much easier and will go much, much faster. In fact, I think we just have one video only for how to do the liability schedules. Until then, thank you for listening.